All right. Well, I want to thank you for taking the time to join today. What I'm going to do in today's call is um, I'm going to break down exactly how you make money as an apartment investor. I'm going to give you an overview, a high-level overview first, and then what I'm actually going to do is I'm going to open up an underwriting workbook, an actual deal, a sample deal, and I'm going to show you the various pieces of underwriting and how you make money. I'm going to show you how much money you can make from day one all the way through the life of the deal until when you close the deal. So if you stick around and wait until the end, I will go ahead and show that to you. I'm going to get my screen sharing up. All right. So let me start off with just a high level of what the amount of money that you could make in these multifamily deals. So I've got this broken out. There's two different ways you can make deals on apartment investing, and you can be a general partner, or that's like you're putting the deal together, or you can be a passive investor. And both of those are fantastic options. If you're busy and you're happy, with your job or making good money, or you've got a 401k you want to roll over and you want to accelerate your retirement savings, then being a passive investor is an absolutely amazing thing to do. But I think most of you are probably watching today because you want to learn how much money you can make as a general partner. Like if you go out and find an apartment deal and you do some creative financing and you raise some capital to get into a deal, how much money is there in the deal? What does the pot of gold look like for you? So I'm going to break this down. I'm not going to spend too much time in there because it's kind of hard to picture. But then what I'm going to do is I'm going to actually show you an underwriting deal, a property, and then we're going to go through the various pieces of that. So if you got some questions along the way, let me know and I will share that with you. What we're doing here is we're assuming a $5 million deal, and that's probably going to be somewhere around the neighborhood of 50 units, depending on the market that you're in. And we have an 80-20 split. So this is limited partners, general partners. And the reason why we have to have that split is because we're raising money. And so the people that are investing in the deal, whether it's private equity, whether it's uh, raising capital, friends and family, or some other way that you're getting funds, those people need to be paid back. So you're assuming a loan, but you're also raising capital to help close the deal. And by putting the deal together, you should be getting somewhere in the neighborhood of 20%, depending on what the deal looks like. I'll explain what we look at and the metrics we want to track of how you could split this up. But 20% of the deal in and of itself goes to you as the general partner to get started. Um, and it also assumes you're investing $50,000. It's going to be more important for the passive investor. Obviously, you can't be a passive investor if you're not investing any money. But as a general partner, you may or may not have to invest in the deal yourself. Most limited partners like to see you invest some money, but it is definitely not a requirement. If some of your other partners are investing in the deal, that goes a pretty long ways. So the first thing I'm going to do is I'm just going to cover the different ways that you can make money in the deal, and then I'll show you if it goes to a limited partner or if it goes to you as a deal sponsor. The first thing we get here is an acquisition fee. And the acquisition fee can range anywhere from 1 to maybe 5%, depending on the deal. But I like to split the difference and just say we're going to go with 3%. So the acquisition fee is what you pay yourself on day one after you close a deal. Now, why is there an acquisition fee? Because you put a lot of time and effort and energy into getting the deal. You had to go find the broker. You had to underwrite the deal. You had to build relationships. You might have even put hard money down on the deal, and you're trying to recoup some of that. So what we get is an acquisition fee. So day one, when you close a deal, if it was 5 million, 3% of that's $150,000. So you and whatever partners are in the deal with you, you guys get to split $150,000 on day one. Now, the property in and of itself, it's going to cash flow over time, meaning over the course of 5 years, people are going to pay rent, you're going to pay your expenses, and what's left is you have money, and that is cash flow. So one of the beautiful things about apartments, you don't have to sell apartments to make money like you do stocks. It pays you cash while you own the property. So if you figured a 10% average cash flow on the deal, then that would be $4,000 a year if you had invested $50,000. Or if you invested $50,000 as a general partner, that'd also be another $4,000. So you would make $20,000 in cash flow from this $50,000 investment. But then there's also the 20% that you get from your GP ownership as far as putting the deal together. So because you got this 20%, you get an additional $45,000 per year. So over the course of 5 years, it's another $225,000. You also, as a general partner, get an asset management fee. You get a 2% asset management fee. And so we assume 50 units, it's going to be about $1,000 per month. This is going to be your income for the property. And then at 2%, you don't get that as a limited partner. You get that as a general partner. You're not doing the property management. You are basically managing the property manager and making sure they're implementing your business plan. And that might even include having to get a new property manager for the property. But that's another $12,500 a year if you look at it that way. So it's another $60,000 that you get to make from asset management fee over the life of 5 years. Then you have your gain from the sales proceeds. So in this example, we're assuming it's an 80% return on investment for the passive investor. So if you got half of it here, you get the other half of it when you sell the property. So you made $20,000 as a passive investor, but if you invested as a general partner, you also get $20,000. Now, then the last piece of this is because you have this 20%, then there's your portion of selling the property. The limited partners don't get that. They get it here, but you get another $360,000. So in this example, if you're a passive investor, you would have invested 50,000, you'd get $40,000 back over the course of about 5 years. So it's a pretty good return. It's about 15% average annual return, actually 16% average annual return. It's a pretty solid deal. Plus, you get tax advantages. So if you stack that up against other types of investments or traditional stocks, bonds, investments people do, it is a much better investment vehicle. And this is why I think a lot of people should consider apartment investing as alternative investments, even if it's a passive investing move for you. Now, if you were a general partner, you would have invested $50,000. Maybe you did, maybe you didn't, but in this case, we're assuming you invested $50,000. So you would have got this just like a limited partner, because that's where your $50,000 goes in. Plus, you would have made all these other fees right here along the way. So you would be getting back at the end of it. You take your $50,000 out, but you'd make $835,000 over the course of 5 years. So that right there at a really high level, that is how you make money as an apartment investor, leveraging other people's money to help close the deal. So you have the bank, they bring in a very large portion, but if you can raise capital, or you and your partners can raise capital to cover all of the money that you need to close a deal, then you can get into a deal and make a lot of money. So this is how you make money as an apartment investor. So I get a lot of people say, Steven, show me a little bit more about how it works. So that's what I'm going to do right now is I'm going to walk you through an actual underwriting example, and I'm going to break down some of the pieces for you. Now, I'm not going to get into a ton of detail here. This takes lots of training to understand all the nuances, but I want you to understand what goes into underwriting a deal and how we get to these numbers. So, like I said, if you've got some questions along the way, feel free to ask me. I'll do my best to keep looking in the chat. So I'm not going to explain every field that's on here, but what we do is we come up with we know what the asking price is, and then what we're going to offer on the deal. So just because a broker is saying, "Hey, I need $5 million for this," doesn't mean you actually have to pay $5 million, especially in today's market. You can definitely come in under the asking price. But what we do here is we take a look at what is the existing unit mix, how many there are, current rent per month, and then we come up with what's called the pro forma. This is going to be our future rent. Once we do some unit renovations, once we increase rents, what is that going to look like? So we build this out right here. So right here, we're already starting to figure out what our income is going to look like from our rent increases. Then we come in and we say, well, what are our current expenses? We break that down and we look at our operating expense ratio here. And then we come up with our new expenses. This is pro forma. So anytime you see pro forma, this is going to be forward looking. This is pro forma means your future projections for the deal. And actually, I should back up a little bit. This number right here, this is when we're underwriting deals, this is what we care about. This is all about, can the passive investor make money? And they're a limited partner, so I want you to think of them as a partner in the deal. So if the deal doesn't make sense for the passive investors, then it doesn't make sense for you. You move on. So this is what we're looking at right here. Any of the numbers we change, it impacts this. This is the goal here for the passive investors. And I'm going to say probably at least 80% back for the passive investors over 5 years. And ideally 6 to 7% at least cash flow on these deals. So everything is revolves around this. If I can get this to work, then I'm going to move forward and submitting an offer. So anyways, we have our expenses here. We break down contract services, utilities, repair, maintenance, payroll, marketing, insurance, property taxes, property management fees, everything we can think of, we're going to put it into this deal as far as the expenses. Then we need to come up with our budget. That's called CapEx, so capital expenditures. And sometimes our budget helps create revenue, and sometimes we just need it because we got to fix some things. So I'm going to go through some of the common things you have in your CapEx budget. These are the things we put into our underwriting. And once again, all this is going to lead to, I'm going to show you how we get these numbers. Like, Stephen, this is great. You showed me that one intro screen, but how do you get those numbers? How does the deal actually perform over time? And this is exactly how you do it. So then we come in and we say, look, I got to upgrade some of these units, but I got to spend some money to do it. I'm going to also implement washer and dryer sets. I got to spend some money to do it, but it's actually going to make me some money. It's going to make me about $16,000 a year in revenue if I can do that. The other thing I'm going to do is I'm going to put in some private yards. If I can do that, it costs me some money, but I can generate some revenue. Um, you can do some other things, like you can do an internet contract, you can do covered parking, you can do reserve parking. There's a lot of different things you can do to help generate other income. I've seen Amazon lockers, things like that. And then you also need to have a little bit of a budget for what about those other things that go wrong? So that could be HVAC units, right? You got your heating and air conditioning units that go bad, or maybe there's a boiler and chiller that you've got to repair. Maybe you have to do roof repairs. And so all of these things that just build your budget. Like, how much money do you need to go into this deal with to fix whatever's broken and do your renovations? You need to have that figured out. And so we figure that out in our underwriting. And then how much is that going to increase our other income? I'm going to come back to this 5-year cash flow deal in just a moment. But we also got to see what our loan options are. But one way or another, the deal has to be paid for. And generally, on these deals, we're bringing in a lender to come with somewhere between probably 60 and 70% of the amount. We're going to work with a lender for that. And so right here, most of those loans are based off the 5-year, 7-year, or 10-year treasuries. There's also bridge loans, and that's a whole other conversation. And then this SF represents seller financing. So if you found a deal and you want to do seller financing, you could come in here and you could figure out, like, what rate do you want to work with them on? Do you want to do interest only on that? Is there any finance rehab? Is it going to be a bridge loan? And then just some notes to yourself here, and this will calculate your max loan proceeds. So we figure out what our loan options are going to be. We also come in here and we figure out what the closing costs are going to be. So we got some formulas in our underwriting that figures out what those closing costs are going to be, because there's a lot of fees that go into closing a deal. So you need to account for that when you're going to be closing a deal. But this is the first place we make money. This is the acquisition fee. And so I've got a 3% acquisition fee. And you'll see that's calculated here in the closing cost. So in this deal, and I'm going to show you a more broken out view of it, but in this deal, day one for the $4.4 million, if you had a 3% acquisition fee, there's $132,000 as soon as you close the deal for you and your partners to split up. Okay, so that is the day one. That's the first place you get to see the money. So the very last thing I'm going to do here before I go into actually showing you the breakdown of the where all the money comes from and how it comes over the course of several years, is we have to build a 5-year forecast. Okay. There's a lot of numbers on the screen. I don't want you to get overwhelmed, but I just want you to understand what we're doing is we're looking at the last 12 months, that's T12, and the last 3 months. We're kind of just gauging how the property's been performing. And then we do a projected year 1 through 5, actually all the way out to year 6. Okay. At a high level, what we have to do is figure out what our rent increase is likely going to look like over the next 5 years, what our other income increase might look like over the next, I guess, 6 years. And our annual expenses are going to go up as well. And then we look at things like what is our economic vacancy going to look like? And the way we get this is by looking at industry data. So you can use a CoStar report, you can use Crexi. I think Yardi has some of this, but you can get a lot of this information just simply by working with a broker without having to pay any additional fees to get this type of data. So, but what we do, what's important here is you need to understand is we figure out what the next 5 years is going to look like to the best of our ability. And we want to be conservative when we do that. We don't want to be overly aggressive because I could come in here and I could pretty quickly say, oh, my rent increase is going to be 3.5 across the board. And watch what happens to these returns as I do that. I can say, I can be very optimistic here. And I say, oh, this is going to be 3.5 and this is going to be 3.5 and this is going to be 3.5 and the deal is going to look really good. But if you're over optimistic and the property can't perform, then you're in trouble. Not only are you in trouble with your passive investors, you might be in trouble because you can't pay the loan. So you've got to be able to really do this right. And I cannot stress how important it is to get that industry data or have a mentor, somebody who can actually show you how to do this and get these numbers right. Because there's a lot of them here. Okay. So I'm just going to pause. I'm going to take all this underwriting stuff and I'm going to put it over to the side. But what I want to show you now is some more numbers, but these are important numbers. This is the returns on a deal. This is a deal that I put together as an example. Roughly, it started at 5 million, brought it down to 4.5. Normal negotiations. So now I'm going to show you the money. You guys are saying, Steven, show me the money. So this is how the money works. So if you're looking at apartment deal and you're thinking about being a general partner, pay attention to this because this is going to help you figure out how many deals would you need to get into in order to hit your target numbers. What if I split that with another partner, 2 partners, 3 partners? This is going to show you exactly on this deal, if you were to do this 2, 3, 4, 5 times, how much money would it make for you and how long would it take you to get there? Okay. So this is how you're going to realize your dreams by understanding this right here. So pay attention to this part. I mentioned in that opening slide that you can do, somewhere between, 20 and 80 for the split. In this deal, when I brought that price down to 4.4 million, I can actually do a 30-70 split. So as a general partner, I can make more money. Some people have to, in order to get a deal, they have to do a 90-10. So as a general partner, I make a lot less money. So what I'm telling you is you want to shoot for at least 20%, but it's also okay for you to do 30% as long as it makes money for your passive investors. Okay. So this is at a very high level. This is cash flows for everything without having without breaking it up between a general partner and limited partner. So this is just a cash flow of the deal. It's going to cost us $1.5 million to purchase this, including our rehab budget. Okay. So this is the money that we need to bring to the table. The bank's going to come in, but we need to come up with another $1.5 million. So you either need to get private equity, you need to JV, or you need to raise capital or find partners to help you bring $1.5 million to the deal. But if you can bring $1.5 million of other people's money to the deal, then you can get into this and make money without having to put any of your own money into it. Okay. So this is just understand this. Then what we do is we break this down. This is cash flow to sponsors and equity partners. So we have before tax projected cash flow of the deal. This is going to be any tax that you pay. This is not real estate taxes. This is just before any taxes that you pay. So these numbers match here. Then there's an asset management fee. Remember I told you about this is 2%. So this 2% asset management fee, that's going to go down to the sponsors right here. So we're going to promote that to the sponsor and the asset management fee. So this is the second place you make money. The first place you make money is your acquisition fee, the 132,000. Then as a deal sponsor, you're going to make another year one asset management fee, about 12,000. Year two, about 13,000. Year three, a little over 13,000. Year four, closer to 14,000 than year five. We're assuming a 5-year hold. If you can do it faster, if you can implement your business plan faster, I'd recommend you do it. But this is the first place as a general partner that the second place actually, because you make the first one is the acquisition fee. This is the second place you start to make money. Okay. Then, so you have $114,000. It's cash distributed after the asset management fees. So you take this, you minus this out. Then you have 30% of the deal. So this is of the cash flow. You have all of this. You take out your asset management fee. You're left with this. You take 30% of this. And you got $34,325 left in year one to pay yourself as a general partner for you and your partners. So in year one, this is how much money on this deal. If I got into this with one or two other people, we'd have $178,000 to split up between us in year one. Year two, we don't get that asset management fee, but we start to get, we would get this, and then it starts to tick up from there. And I'm going to come back into this the selling of the deal here in just a moment. Okay, because the other thing we haven't talked about here is this is what goes to the passive investors. So this goes to the people who are investing in the deal with you. So this is how they make their money. So year one, you to your passive investors, you have $80,000. Year two, 105. Year three, 124. And year four, 132. Year five, 141. So that's the money your passive investors make. But for you as a general partner, you make this the first year, and then you make this over the next few years as cash flow of the deal. But then you get to year five, or as soon as you can sell the property, you've implemented your business plan. When you sell the property, there's a pretty large gain here. So there's another, when you sell the property, you've got another large capital event where you're making a whole bunch of money. So that portion of it is going to be for you and your partners is going to be in this particular deal, $588,000. So in year five, when you sell the property, there's $663,000 for you and your partners as soon as you sell that property. And total over the course of 5 years, once again, if you can implement the business plan faster, do it. Ideally, 3 years if you can do it. But this is where this deal, if you could get this deal all on your own, then this deal would make you $1 million. The reality of it is, though, it generally takes 2, 3, 4 deals because you're going to be doing it with other people. And trust me on this, working with other people allows you to move way faster. If you are of the mindset you're going to do this all by yourself, then it's a very limiting belief and you're slowing yourself down. I was that way. I'm guilty. I did that. I was like, I'm going to do it myself. I'm going to do it myself. I'm going to do it myself. And I didn't take action. I didn't take action. I didn't take action because I had too many plates I was trying to juggle. Not only did I have a family and a career, but trying to do all of these things, find the deal, underwrite the deal, raise the capital, do the asset management, bring all these other things to the table. I just didn't have it. So working with a partner or two, you can move a lot faster. So if you can be of the mindset of, I'm going to work with a couple other people, and if we can do this and we can get into 3 or 4 deals, then you can see your path here to start making a lot of cash flow from these deals. And if you can be patient and put in the effort, you have big rewards at the end of this. And that is how you make the money in these apartment deals. So I'm going to check really quick and see if I've got any questions that have come in. Doesn't look like I do. So if you've got questions, once again, drop them in the chat. But this is a real deal. I'm currently underwriting this deal, waiting to hear back from the broker on it. But there's a good chance I'm going to be submitting an offer on this deal. Okay. So I took the name out of here so that you guys weren't going to compete with me, but this is a real deal. This is the potential for me, and I probably do this with one other person. So another person and I, we're going to get into this deal. We're going to raise as much capital as we can. We will probably put in a little bit of our own money, but this deal will probably make us each a $500,000. Okay. So if that's something that you're interested in, then what I want to do is I want to share with you some options that you have in front of you. I want to help you hit your goals. So if you want to be an apartment investor, if you want to make more money, if you want to become a millionaire, you can do this. And so I'm launching a new school community to help you hit your goals. It's a 6 month program. You can be in it longer or you can be in it shorter. It's a twice a week we're going to meet. We're going to meet through the school community. We're going to do deal review and QA on Zoom calls twice a week. I'm going to give you a full library of trainings on locating deals, underwriting deals, and submitting offers. So this exact underwriting worksheet that I just showed you, there's a whole training section in there, also locating deals, submitting offers, everything basically to get you up to that point to be submitting deals. So if you join, you're going to get all those Zoom calls are going to be recorded. You're going to be able to network with other members in the group. Remember, I told you how important it is that you are working with other people in the group. Very important. And you'll be able to partner with other members in the group. Stay as long as you want. If you want to stick around in the group longer, go for it. And if you find out the group's not for you, you can cancel anytime you want. And how are we going to do this? Why 6 months, Stephen? 6 months is really to help you with milestones to push yourself. Because if I said, get in here and just, take your time, you might not push yourself. But this timeline is very realistic for you guys. So, month one, it's going to be a foundation and just help you understand how to start finding some deals. Month two is going to help you. We're going to teach you how to underwrite and do a lot of deal analysis. The month three, we're going to do building your team and investing your building your investor network. And also month four is going to be about submitting offers and negotiating deals. Month five is going to be due diligence. This is where you show up to the property and you do all of your inspections. And month six, I'm going to push you guys to close your first deal. So this is what you're going to get by joining this program. It's going to be through school. It's going to be a pretty awesome program. And a lot of you are going to be very successful. Though those of you that show up and put in the effort, you're going to be very successful. The way we're going to do this is it's going to be $297 a month. Like I said, stay as long as you want, cancel anytime. But because we're just launching this, we got a pretty awesome promotion going on. My team told me I shouldn't do this, but I told them it was more important to help people out. So what we're doing is it's $97 a month only for the first 25 members. Once we hit 25, the price goes up. Okay. So it's going to go live March 17th at 9 a.m. Pacific. And I think we're going to get a wait list link in the chat for you here in just a moment. So if you want to get on the wait list, you will get priority and you can be in that group of the first 25. So with that, I'm going to pause for a moment. I'm going to make sure we get this in the chat, the link to sign up. But who seems like they're interested in doing this? Okay, so we got the link in the chat. We've got the wait list in there. So go out to the wait list, sign up on there. We've got the school community. And actually, here's what I'm going to do for you guys. Give me just a moment. I'm actually going to show you what's in that school community because there's a whole lot of training in there. And I'm super excited about this. We've been putting this together. So give me just a moment. And I will get that up as well. And I'm going to show you what's in that school community. Okay, so here we've got in the classroom, we're going to walk you through the multifamily fast track. The course is called Multifamily Fast Track. So we've got a section in here for locating deals. We've got a section here that just walks you through the overall acquisition process. And in here, we've got a whole lot of trainings that are going to cover the underwriting process. And we're going to give you access to additional resources. So you're going to get the underwriting spreadsheet. You're going to get some sample deals. You're going to see all of the files that you need to do the underwriting, the T12, the rent roll, the delinquency report. You're going to see sample loan documents. You're going to see all kinds of great information in here. So we've got a whole bunch of training in here for that. We're going to give you the education you need to do the site visit and to close a deal. And then we're also going to share with you some strategies to raise capital. Then We have, if you guys are ready, when you're ready, if you want a more personalized approach, access to a inner circle group of people who are out there actively closing deals, and you want more access to me from a one-on-one standpoint, for those of you that are ready, there's going to be another opportunity for you to get into this accelerator program. So, but the first step really is just to get in and get into this program right here. So that's what we've got lined up for you in the program. In the calendar, we're going to do twice a week calls, and these are going to be the bring us your underwriting, bring us what you're stuck with, whatever you're working on. We're going to work through this as a group, and we're going to help you hit those goals. All right, and I think we've got something here in the Q&A, so go ahead and sign up that link. All right, I've got a question here. I'm going to read this out loud. We're going to see what we get here. Please excuse this question. I need your advice. I have properties I can purchase, but I don't have the down payment. It's $95,000. I've been approved for 5 DSCR loans from different lenders besides reaching out to private lenders and doing credit card stacking. What are other options where we won't have to pay back 50K on top of the down payment? How can I make 6 figures easily? My only thought is to wholesale properties via Zillow and give it to a hedge fund. I think there's a way easier path to this. I think the problem is, I think you're trying to do this alone, and you're trying to do it alone, and you're not leveraging other people who could help you have that $95,000 down on a deal to acquire it. I think that's probably what's holding you back. My guess is you're doing this alone because you want the biggest piece of the pie you can get. What you need to do is get some partners, and you guys can go faster by doing this. So there's a whole lot I don't understand about that. If you want to reach out to me through the school group, we can have a chat that way. But yeah, the cost there, yes, there's ways to do this, but it's a very expensive way is what it looks like you've lined up there. So all right, folks. Well, I appreciate you taking the time. I know this is a lot of information. I'm excited to kick off this program and have you guys attend. It's a fantastic deal to get you guys in. If there's no other questions, then I will let you go. Checking. No other questions. Thank you so much. If you got other questions, reach out to us via the school platform. Go ahead and just send a message to me directly or post in the forums if you've got questions in the forums, and we'll get those questions answered for you. But the most important thing is get on that wait list, because when we open that up, I want to give you that discount if it's available, because once we hit that number of 25, the price is going to go up. Okay. All right, folks. Thank you so much for joining this week, and I will see you again next week for a new topic. We can help you hit your goals in multifamily investing. Thanks, guys. Bye.